Hi everyone. We will present you the article about assessing the contribution of banks, insurance, and other financial services to systemic risk, which is realized by Bernal, Oscar, Gnabo, Jean-Yves, and Guilmin. So first, the introduction. So the starting point of this paper revolves around the notion of financial system. It is therefore appropriate firstly to define precisely this concept, and that will in turn lead to the presentation of the general context. So a financial system is defined by the set of rules, practices, and institutions, so for example, stock exchanges, banks, etc., that make it possible to mobilize capital, to make them available to agents with financing needs. These needs essentially correspond to investment projects of companies, administrations, or individuals. An abundant literature shows that a stable and efficient financial system is essential for sustained economic growth and improved standards of living. The financial crisis has reminded us of how risks materializing in one part of the financial system can have a widespread impact, affecting other financial markets and institutions and the broader economy. This aspect clearly refers to the notion of systemic risk, which is brandished by economists as the alpha and omega of the contemporary financial economy. Systemic risk is inherent in the banking and financial system because of the interrelationships in this sector between different institutions and markets. So now about the main motivation and the aim of this paper. So first, the main motivation behind this paper is exactly the fact that in a globalized and financialized economy, economic agents are becoming increasingly more interconnected. This favors the spread of adverse shocks occurring in one or several financial sectors, not only to the entire financial system, but also to the real economy. And the aim of this paper is therefore to contribute to the debate on systemic risk by assessing the extent to which distress within the main different financial sectors, namely the banking, insurance, and other financial services industry, contribute to systemic risk. So the research gap that the paper tries to fill. So the existing literature has investigated extensively the transmission mechanism of risks from one institution to another within the same sector. So, for instance, in 1983, economists Douglas Diamond and Philip H. Dybvig have published the Diamond and Dybvig model, which helps to understand how an institution with long maturity assets and short maturity debt may be unstable. Another example concerns Allen and Gale, who in 2006 have especially focused themselves on the insurance industry. All those authors thus only investigated the way shocks propagate within a given sector. Nevertheless, empirical evidence is still scarce regarding how disruption in one particular sector can spread to the entire economy and whether a specific sector is more or less risky than another. To this end, the paper first estimates the extent of the contribution to systemic risk of the banking, insurance, and other financial services industry, and second, it establishes which of those industries contribute the most to systemic risk. The research strategy adopted in the paper to fill the gap. So the empirical strategy developed in the paper to assess the contribution of the banking, insurance, and other financial services sectors to systemic risk relies on the Delta-Kovar systemic risk measure proposed by Tobias Adrian and Marcus K. Brunner-Meyer in 2011. There is, however, one significant limitation of the original Delta-Kovar measure of systemic risk: the absence of a formal test to compare the relative contribution of each individual financial institution or financial sector. The paper deals with this limitation by implementing the Kolmogorov-Smirnov test, which is based on bootstrapping techniques and which allow to implement both a significant test to know whether a given financial sector contributes significantly to systemic risk and a dominance test that aims to assess whether one particular financial sector contributes more to systemic risk than another. So about the literature review, so this literature review has allowed to define the 4 main points of differentiation of the paper. So firstly, this paper does not allow to limit the definition of the system to the banking sector or to the financial system, as it is often the case in the literature. Here, these words refer to the real economy. This main point of distinction allows to evaluate, as previously said, the way shocks within a given financial sector affect the real economy. So secondly, although the literature focuses on the banking industry, the breakdown of companies, other banks such as hedge funds or insurers can also have a critical impact on the real economy. That is an aspect which is neglected in the literature. The paper of Adrian and Bruno Meyer in 2011 on Delta Covar, for instance, only focused on banks. We can also illustrate that by the fact that previously to this paper, there were no quantitative approach to the insurance sector. There were only literature discussions. The second advantage of the paper is that it compares the contribution of the main components of the financial system, so the banking, insurance, and other financial services sector to systemic risk, rather than focusing on the contribution of individual financial institutions to systemic risk. Thirdly, there were many measures of systemic risk proposed in the literature along with time, but some of them appear not to be extremely relevant because of various shortcomings. There were also top-down measures such as the systemic expected shortfall introduced by Acharya et al. In 2010, which aimed to determine the impact of distress occurring at the level of the financial system on an individual financial institution. With this respect, the Delta Covar measure of systemic risk proposed by Adrian and Bruno Meyer in 2011, which is also used in this paper, distinguishes itself by being both a bottom-up and a top-down systemic risk measure. Here it is so used as a bottom-up measure in the sense that it assesses the impact of distress at the level of a single financial institution and the transmission of the associated risks to the entire financial system. This original Delta Covar measure of systemic risk faced, as previously said, one major failure, the absence of a formal test to compare the relative contribution of each individual financial institution or financial sector. The third important contribution of the paper is that it deals with this limitation by implementing the Kolmogorov-Smirnov test. The authors also follow the bootstrapping strategy developed by Abadi in 2002 to deal with the Durbin problem that occurs in the implementation of the KS test when two cumulative distribution functions are not distributed free. So the fourth point, so finally the determinants of systemic risk are examined for both the Eurozone and the US economies. The literature previously only focused on the USA, as it is the case in the paper of Adrian and Bruno Meyer on Delta Covar in 2011, for instance. Since these two regions, which were at the center of the financial crisis discussed in the introduction, display different regulatory frameworks, so we know that there is, for instance, often more strong banking regulation in the USA. Comparing the propagation of risks in each area should provide interesting insights regarding the existing link between systemic risk and the standards that financial institutions are expected to meet. In this paper, we observe if banks, insurance, and other financial services are relatively more at risk for the system in this or that region of the world. If an industry is risky, it is assumed that the level of regulation is not large enough in relation to the intrinsic risk of this industry, and therefore it implies that the regulator needs to focus himself on this sector. This shows where to concentrate the efforts to put in place in the future in terms of regulation. With these four main contributions, the paper is likely to be highly relevant to to government and central banks for regulatory purposes. So let's now focus in details on the core of the paper. Data. So in the paper, the authors use a stock market index as a proxy for the system. They use the S&P 500 X-Financial Index for the United States and the Stoxx Europe 600 X-Financials Index for the Eurozone. In both indices, financial companies are excluded from the index to avoid spurious correlations between the variables of interest. The Eurozone and US stock market indices related to the three financial sectors are presented in Table 1 and 2 respectively, so here and here. Their related state variables used in quantile regression are also defined in these tables. So the empirical analysis spans the period from September 21, 2004 to March 16, 2012. Overall, the sample is made up with 1,765 daily observations for the Eurozone and 1,813 daily ones for the United States. So about the methodology, so this paper uses the delta cover methodology. This choice is motivated by two main factors. So first, the delta cover relies on high-frequency stock market data and is therefore a highly reactive systemic risk measure. Secondly, this measure is particularly well suited for analyzing the extent to which distress within a given financial sector is transmitted to the real economy of the Eurozone and the United States. COVAR is a technique for capturing a financial institution's contribution to systemic risk based on market data and the value at risk methodology. COVAR measures what happens to the system's VAR when one particular institution is under financial stress as measured by its own individual VAR. This instrument will make us able to answer two general questions. So the first one is, what is the VAR of the financial system if a particular institution is under financial stress? And secondly, how does the VAR of the system change when a particular institution becomes financially stressed?
We will now describe more precisely the six-step procedure used in this paper to estimate the absolute and relative contribution to systemic risk of the banking, insurance, and other financial services industries. To do so, we will use the example of the European financial system and of European banks. In the first step, we estimate European banks' returns by making quantile regressions. The returns in question depend on a certain number of state variables which determine the environments in which European banks evolve, namely the liquidity spreads, the credit spread change, the European implied volatility index, and so on. Remember that a quantile regression is a specific type of regression used in statistics, while the least squares method provides an estimate of the conditional mean of the dependent variable given certain values of the independent variables. The quantile regression approximates either the median or the other quantiles of the dependent variable. In a linear regression, the regression coefficient represents the change in the dependent variable produced by a unit of change in the predictive variable associated with this coefficient. The quantile regression parameter provides an estimate of the change in a specific quantile of the dependent variable produced by a unit of change of the predictive variable. In our case, we applied these quantile regressions for two different levels of quantiles. On the one hand, for a quantile at 1%, which represents the case where European banks are in distress, and on the other hand, for a quantile at 50%, which represents the case where European banks are in a normal situation. Note that robustness checks where quantiles of the normal and stress situations are changed are proposed in appendix C, D, and E of the paper. Results of the quantile regression estimates are presented in details in tables 9 to 40 of the appendix B of the paper.